Hello friends, good morning to all of you, and in this session we are going to cover the second part related to the chapter investment management. So do confirm at the earliest so that we can proceed. So we are covering the module D of the retail banking and the wealth management. So do confirm at the earliest so that we can start covering the video today. And if you have not subscribed to the channel yet, do subscribe the channel. And further, there is a study plan which is now available, which is now live, where you will be selecting the number of days, you will be selecting that how many hours you can be spending on daily basis. You'll be selecting the exam, you'll be selecting everything, and the complete study plan will be generated through it. And you can even be downloading it for free, right? So the link is already shared with you. So do follow the link, and for the definitely you must be downloading the study plan. So let's start the session today. It's about the difference between the investment management and the investment banking first of all. Now, what is the difference between the investment management and what is the difference between the investment banking? Let's have a look at it. The first of all, if we look at the focus, in case of the investment management, like we do focused on managing the client portfolio and the assets for the client basically we are working, right? And when we're talking about the investment bank, it's basically like we are providing the financial services for capital raising purposes, for advisory services, for underwriting purposes, right? So the focus is basically on providing the services, but in case of investment management we are focusing on managing the client portfolio and the assets. And if we look at the services which are provided, right? So those are the portfolio management services, asset allocation, investment advice. And in case of the investment banking, it's capital raising, M&A, advisory, trading, underwriting, etc. These services are provided. And what is the client base? The clients could be the individual investors, these could be the institutions, these could be the pension funds. And when in the case of the investment banking, we are talking about the customers are the corporations, in governments, institutional investors, and HNIs, that is high net worth individuals. And the main objective is related to what? Related to the investment banking, that we want to maximize the return. We want to maximize the return in case, and with the control risk we want to do that, right? But in case of investment banking, the main focus, or the, let's say, the main objective is related to so as to help the client execute the financial transaction, right? And if we look at the key services, it's like portfolio management, like I just told you, the asset allocation, like these are the key services being provided, right? And let's have a look at the involvement in IPOs. Like generally the investment management is not involved in underwriting. In underwriting it is not involved, right? So don't not directly involved in IPOs or underwriting the new securities. The investment management is not involved. But the investment bank is basically involved in underwriting because they are going to provide the underwriting facilities, right? So they're directly involved in IP underwriting and the issue management. And if we look at the uh, investment types, the investments, so we are investing in equities, bonds, ETFs, commodities, real estates, etc. These are the investment types. And if we look from the investment banking point of view, the investment is basically related to new securities, related to the debt instruments, related to the M&As, IPOs, right? And further, if we look at the responsibilities part, like what responsibilities they do have, they are to research, they are to select the security, they are to do the analysis, right? They are to basically do the risk management, they are to do the rebalancing. That is basically done. That's a core part of it. And if we look at the investment banking, it's like they are to issue the debt, and they are to evaluate, and they are to do the underwriting, they are doing the market making. So these are the core responsibilities they are handling. Okay, clear with it? After that, the next one, it's about the portfolio. So portfolio is basically what? It's a collection of the financial assets and investments. Like when you're having the multiple assets and investments with you, it's basically a portfolio. It may be related to an individual, institution, or an entity. Okay. And there could be different types, like it could be the equity or the stocks, or it could be the bond, it could be the debt instruments like debt, like bonds, debentures, debt mutual fund, etc. Or it could be a hybrid component of it, like the balanced funds could be there, or the asset allocated funds could be there, or it could even be the alternatives. Like I just told you about the alternatives also, like real estates, commodities, precious metals. These are the alternatives. These are the alternatives. And the exchange traded funds, these are under what category? These are under the market linked products. These are the market linked products. So I'm telling you about the asset type. Like we are having the asset type like equity, debt, or it could be even the hybrid, it could be the alternative, or it could be market linked product. Okay. And what is the main purpose of creating the portfolio? Because we want to generate the return. Definitely, we are having some specific goals. We want to generate the return for the risk management purposes, right? We want to achieve our goals, and also for the tax efficiency. We want to reduce our tax liability overall. That's basically why we do the why we do maintain the portfolio. And then after that, it's about the portfolio management. One term, it's about the portfolio. The another term, it's about the portfolio management. Now, what is portfolio management? Like it's a professional management of the investments. The professional management of the investment, right? So as that we can be achieving the investor's financial objective. And at the same time, we have to balance the risk and return, right? So it's a professional management of the investments, right? And further, we want to achieve not our goals, but we want to achieve the investors financial goals, right? And at the same time, we have to balance the risk and the return. That's about it. And what are the steps? First of all, we should be analyzing the or identifying the objectives of the investor. So we have to define the financial goals. We have to look into the risk tolerance of the person. We have to look into the time horizon, that for what particular period the person is want to just achieve the goals, right? Or the liquidity needs, constraints, whatsoever. We have to identify the objectives. Second thing, we have to estimate the capital market. We have to analyze the economy, interest rate, inflation, market trends. Then we have to take the decision about the asset allocation. Like decision should be taken, like what amount we have to allocate toward the equity, what toward the gold, what toward the debt, etc. That is to be done. And the complete portfolio strategy is to be formulated after that. That's the fourth step. We have to choose that whether we want to be active or passive, or we want the growth one, like whatsoever we will be earning that will be invested into it, or we want the income one. So whatsoever we are getting like earning, we'll be getting it, we'll be using it in a daily life, or it could be a balanced strategy. So we have to basically select a portfolio strategy. Then after the strategy is selected, we are to select the suitable securities. The suitable security selection is to be done. Like specific stocks, bonds, ETFs, etc. are to be selected. And then the complete portfolio is just implemented. And that's not the end game. Now we have to evaluate. We have to evaluate that whether the objectives that we chose, are we able to like achieve them? Right? So we have to compare the actual performance with the objectives and the benchmarks. And then we have to do the rebalancing. Rebalancing the composition is to be done. Okay, so we have to restore the original asset allocation by buying or selling the assets periodically. That is to be done. Clear with it? So these are the 8 steps that we have to follow. Let me just reiterate the steps. First thing, we have to like identify the objectives, the risk appetite, the tolerance, the time horizon, everything. We have to estimate the capital market, analyzing the trends. We have to take the decision about the asset allocation, where the funds are to be allocated. We have to basically formulate a strategy about it, whether we want the active growth, passive growth, growth one, whatever. Then we are to select the investments and the securities. Further, we are to implement the portfolio after that. And then we are to evaluate and revise the portfolio, and the rebalancing is to be done, right? So these are the 8 steps which are to be followed for the portfolio management purposes. Now let's have a look at the types of portfolio management services, the types of it. The types of it. The first one, it's about the discretionary portfolio management, right? So the first one, it's about the discretionary portfolio management services. Like in this case, what happens actually, that the portfolio manager makes the investment decisions. So discretionary powers would be available with the portfolio manager. So the portfolio manager will be taking the decisions related to investments on behalf of the client. So the decision authority is the portfolio manager, right? The second one, it's about the non-discretionary portfolio management. Now, in this case, you are the owner of your game, right? So portfolio manager just gives the advice. So recommendations are given by the portfolio manager, is going to give you the recommendations, but the final call will be on the investor. Investor retains the final call. That's about the non-discretionary PMS. Further, the third one, it's about the active portfolio management. Active portfolio management, when there is frequent buying and selling of the securities, you are doing the rebalancing, right? So as to basically outperform benchmark. That is said to be the active portfolio management, and the decision like authorities with the portfolio manager. So here also the portfolio manager, they are going to take the decision related to the parts, right? Further, it's about the passive portfolio manager. Passive portfolio management, like it is going to replicate the benchmark performance. Like what's the benchmark, we are just to want to replicate that thing, right? And we want to achieve the market returns just by replicating the performance of specific index. So it's rule based, it's index based. So that's the fourth type of the portfolio management. So the first type, it's discretionary portfolio. The second one, it's the non-discretionary portfolio management. The third one, it's the active portfolio management. And the fourth one, it's the passive portfolio management. Clear with it? So that's basically about it. And what is the regulatory limit? So as per the SEBI framework, if we look at the SEBI, that's the Securities and Exchange Board of India. If we look at the SEBI framework for PMS, we say this to be the PMS, Portfolio Management Services in India, right? The minimum investment is what? The minimum investment amount is rupees 50 lakh per client. It is the 50 lakh rupees per client is required for the portfolio management services, and the PMS providers must be SEBI registered. Okay. Now let's have a look at the role of the portfolio management. What is the role? So first of all, it's about, if we look at the point, it's about the diversification. We want to diversify. Like diversification is related to spreading the investment across the asset classes, across the different sectors, across the different geographies, right? Because we do not want to reduce the money. So the diversification reduces the unsystematic risk. It reduces the concentration risk. Okay, that's the first part. That's diversification and the risk control, we can say. The diversification, and further, it's about the risk control or reducing the risk. The second thing, it's about the optimization. Like we want to optimize our portfolio so that we can be getting the maximum returns, right? So basically, through the portfolio management, we want to seek the better risk adjusted return. We can be doing the monitoring. We can track the performance against the goals and benchmarks. So the monitoring and evaluation of the performance. That's there. So that's the second thing. That's about monitoring, evaluation, return optimization, right? And the third one, we want to do the tax planning. That's quite important. We want to reduce the overall tax liability, but legally, right? So we want to choose the tax efficient instruments and exit strategies, like where we are having the lower burden of tax. And it's a disciplined approach for the investment purposes. It's a disciplined approach. Why disciplined approach? Because you are avoiding the emotional decisions, because you are being an individual, right? And you are dependent upon the professionals now. So you won't be taking any emotional decisions based upon the rumors. And as I told you that the professional expertise is available. So they will be doing proper research while investments. So these are the 5 points related to the role of the portfolio management. The first one, it's related to you're going to diversify your portfolio, you're going to reduce the overall risk. Proper monitoring and evaluation will be there so as to maximize the returns. The tax planning can be done properly and there will be proper discipline. And then the professional expertise is available over there. Getting it? So that's about it. Now let's have a look at the difference between the portfolio management and the investment banking. What is the difference? So in case of the portfolio management, it's like it's management of the investments of the individual or institutions. That's a portfolio management. The focus is upon that. But in case of investment banking, like we are providing the financial advisory, capital raising, and for the M&A we are handling or underwriting services we are providing under the investment banking. So the main client is individual or it could be the institutional investors in case of portfolio management. But in case of the investment banking, it is like corporations, governments, high net worth individuals are there. And if we look at the objectives, if we specifically look at the objectives, it is related to what? That we want to like give the maximum return while managing the risk for the clients. That's it. So we are focusing upon management of risk. We want to manage the market risk, credit risk, liquidity risk, concentration risk, etc. Whereas in the case of the investment banking, like we are assisting the client related to their strategic decisions and financial decisions. So there is a very huge difference between the objectives, right? So key activities are like asset allocation strategy. We are to basically we are to come out with some strategy, right? And in case of the investment banking, the activities are different, like mergers and acquisitions, capital raising, underwriting, trading, etc. Clear it? So that's the point. So that's the whole point related to it. I hope that you must have the idea that about it. So the last topic for this particular chapter related to the investment management, it's about the portfolio manager. Now, portfolio manager is basically the professional who will be doing the portfolio management. So financial professional who's going to manage the investments on behalf of the individual, institution, pension fund, insurance company, etc., etc. And what is the role of the portfolio manager? What is the role of the portfolio manager? So first of all, they are to provide the portfolio management services. They do offer the portfolio management services, right? They do draft the investing portfolio statement that we say to be IPS. So after understanding the client's objectives, income, liquidity, the risk appetite, the constraints, they are to make a strategy about it. They basically draft the investment policy statement, right? And they are after that they are to do allocate the assets. They are to do the security selection. They are going to control and they are going to manage the overall risk profile, right? So and they'll be doing all these things so as to ensure that the return requirements are there. That the return requirements are there. Clear with it? Now, what are the advantages of portfolio management services? Professional management is there, and definitely it's a tailored one as per your needs, as per your goals, as per your risk tolerance as per your objectives, and continuous monitoring is there, and definitely the risk is reduced, right? And definitely the transparency is there, and diversification, your concentration risk is reduced overall, and it's time saving, better decision making can be done. Okay, so that will be all related to this video. I hope that you must have liked the content. So do rate this video out of 10, and make sure to like this video and further share this video among your friends and colleagues. Now, if you have any doubts related to the chapter number 24, do let me know so that we can further be proceeding. And the next chapter that we are going to cover, it's about the tax planning. Very important chapter, right? And make sure that you are to follow the latest guidelines only. You have to follow the latest guidelines only. So first of all, it's about the chapter number 25 now, related to the module D. Related to the module D. Okay, so let's start it. So the first thing first, it's about the fundamentals of the tax. It's about the fundamentals of the tax. Now, tax is basically what? It's mandatory financial charge. It's mandatory. It's basically imposed by the government on the individuals or the organizations so as to generate the revenue for the public welfare purposes. Let's say they want to provide the infrastructure facilities to the individuals, to the society. For that purpose, they do levy a financial charge. And further, in India, the taxes are levied by both central government and the state government. Both levy the same. And if you look at the taxation system in India, it's basically the process. So taxation is related to process. So whenever we are talking about the tax, it's a liability, financial liability upon the financial burden upon the individuals or the companies, right? But when we're talking about the taxation system, it's referred to a process of levying and collecting the charges from the businesses, persons, entities, right? That's it. So let's have a look at the types first of all. Like if we look at the direct tax and indirect tax, because there are two types. One it is direct tax and the other one it is indirect tax. So direct tax is which is directly paid by the taxpayer. Directly paid by the taxpayer, that is a direct tax. And indirect tax, like tax collected indirectly from the taxpayer but through the goods and services. Let's say if you're buying a packet of biscuits, you're even paying a tax because that's already included in the MRP. So you're paying it to the shopkeeper and shopkeeper is paying on your behalf to the government, right? So that's tax collected indirectly through the goods and services, like GST is there, like customs duty, excise duty, STD, etc. Right? And further, if we look at the governing act for the direct tax, it's the income tax act. And if we look at the governing act for the indirect tax, it's CGST, SGST, IGST act, etc. Right? And further, it is administered by whom? It is administered by CBDT, Central Board of Direct Taxes. And in case of the indirect taxes, it's administered by CBIC, Central Board of Indirect Taxes and Customs. And further, if we look at the incidence, it falls on the person, on the same person. Like who is earning that? The person is to pay the tax. That's basically the income tax, corporate tax, capital gain tax, right? And if we look at the incident related to the indirect tax, it falls on the ultimate consumer, on the final consumer. Okay, so that's the difference between the direct tax and the indirect tax. Now let's understand some important definitions. Important definitions. Like the first one, it's about the assessee. So assessee is a person who is liable so as to pay the tax. So assessee is who? Assessee is a person who is liable to pay the taxes or any other sum under the income tax act, right? So that's a person who is liable to pay the tax. And it is also includes a person who is assessable for another person's income or loss, right? That is also said to be the assessee. And if we look at the definition of the person, You're not to memorize the sections here, just for the reference purposes, those are written over here. So the person could be anyone, like the person could be individual, it could be HF, AOP, BOA, etc. Every single entity. So individual is like natural human person, natural human being. That's a individual. HF is like Hindu undivided family, which is managed by Karta. So Karta is having the ultimate responsibility for the HUF. And companies basically Indian or foreign registered company it could be, right? And further, it also includes all the public and private companies, partnership firm or LLP, like the business entities with profit sharing. Those are said to be the partnership firms or LLPs. And AOP is association formed for common objectives. So it's association of persons. It's an association which is formed for common single purpose, common objective. That is basically the AOPs. And BOI is basically group of individuals, like group consisting of only of individuals. Association of person could be like person is having a multiple definition. It could be a firm, it could be a business, which could be a part of the association of person, but for the body of individuals, only the individuals will be forming a body, right? And for particular purpose, that body is formed, right? That's body of individuals. Further, it's about the local authority, like municipalities, panchayats, the cantonment boards, or other governmental bodies at the local level. That's basically the local authorities. Then for the AJP, if entities are not falling in any of the category above, right? So then those will be covered into this, like universities, okay, right? And the deities, those will be the AJP, artificial judicial person. Okay. Then it's about the definition of the previous year, assessment year, etc. Now, previous year is like year in which the income is earned. We say that particular to be the previous year in which the income is earned. That is basically the previous year. We also say it to be the income year. We also say it to be the income year. Like the financial year 24-25. That's the previous year. And the assessment year would be like, what would be the assessment year? The year in which the income is being assessed and taxed. So it's basically the assessment year 25-26. So whatsoever you have earned from April 1, 2024 to 31st March 2025, that will be assessed in the year 2025-2026. So assessment year is 1 year ahead, we can say. Clear with it? Right? So income earned during previous year is basically taxed in the immediately following assessment year. Right? Then further, it's about the residential status and the tax liability. So residential status is going to determine the scope of taxable income in India. It's going to like look into the scope of taxable income in India. That which income is taxable here in India. That's going to look into the scope of it. So citizenship and residential status are two different things. So if we are looking at the citizenship and the residential status, both are basically a different scope. Both are basically a different scope. So a foreign citizen can be a Indian tax resident. A foreign citizen, it can be a Indian tax resident, right? And an Indian citizen can be a non-resident. Indian citizen can be a non-resident, so that can be the case. So first of all, let's have a look at the categories. Like we are having the category of ROR. This is the first category. That is a ROR. That is resident and ordinarily resident. Resident and ordinary resident, right? And further, the global income is taxable for the ROR. And what is the condition? There is one basic condition. Like if the person stays in India for a minimum 182 days in the previous year, that's a basic condition, or stays for 60 days in the previous year, and further for more than or equal to 365 days in the preceding 4 years, right? If that condition is basic fulfilled, and further there is an additional condition also, resident in at least 2 years, two of the last 10 previous years, and stayed for at least 730 days in the last 7 previous years. So if this condition is fulfilled, this whole condition is fulfilled, then we say the person to be a resident and ordinary resident person. Right? So what is the condition? The first thing, it's about that you are staying in India for minimum 182 days in the previous year, right? Or let's say you are staying in India for 60 days minimum in previous year, and further, and with the same 365 days minimum in preceding 4 previous years, for 4 previous years, plus like this or this, either this or this, plus like if you're resident for at least two of 10 preceding 10 years, 2 of 10 preceding years if you were resident, and further you have total stayed for minimum 730 days in 7 previous years. So if this condition, if this total condition along with this condition is fulfilled, then you will be said to be what? Then you will be the resident and ordinary resident, right? And in that scenario, your global income, like income, Indian income plus foreign income, that is basically taxable. That would be taxable if you're satisfying this criteria. Getting it's something like not complex, but it is basically multiple conditions which are fulfilled. Then you will be having the status of ROR, right? Okay, so and if you just satisfy the basic condition, if you just satisfy this basic condition, but not the additional condition, but not this additional condition, then you'll be the resident, but not ordinary resident. Then you'll be RNOR. Then you will be RNOR. And what is RNOR? It is a resident, but not ordinary resident. RNOR. Okay, in that scenario, your Indian income, and the income, basically the foreign income from the business which is controlled here in India, like the profession that you have set up in India. Let's say you are a YouTuber and further you are earning money, right, from YouTube. That's basically a business which is set up in India. And you are not earning, like you have not established a business outside India for this case. So that will be taxable for RNOR. And further, if the basic residency condition is not satisfied, then you are non-resident. If the basic condition is not satisfied, then you are a non-resident, and then only the Indian income will be taxable here in India. The foreign income is not taxable then in India. Clear with it? So that's about the residential status and the tax liability. The first status, it's about the resident and ordinary resident, ROR. The second, it's about the resident but not ordinary resident, RNOR. And the third one, it's about the non-resident status. Okay, getting it? So after that, it's about the amendment that was actually there. So there was an amendment in financial year 2021. So Indian citizen or person who is not liable to pay tax in any other country due to domicile or residence deemed a resident in India, if the total income exceeds 15 lakh rupees, such persons are treated as RNOR and not ROR by default. Getting the idea? So that was basically the deemed residency rule. That was the deemed residency rule. Like, and first of all, it is applicable from the financial year 2021 onwards. And further, the thing is like Indian citizen that is not liable to pay tax liability anywhere else, and the income exceeds 15 lakh rupees, excluding the foreign income, then the such person is treated as RNOR by default. Then such person will be treated as RNOR. Okay. Further, it's about the special rules for the NRI and PIO. So for Indian citizens who are leaving India for employment abroad, or let's say the crew member, the 60-day condition is replaced by 182 days. For those persons, the 60-day conditions won't be available for them. that is replaced by 182 days. For whom? Like the persons who are leaving India for the employment abroad, or the crew members. So this is a relaxation to them. So they are treated as non-resident until or unless if they'll be staying for 182 days plus. So if they'll be staying at least for 183 days outside India or abroad, then they will be treated as non-resident. The 60 days rule won't be applicable for them. Further, it's about the DTAA. It's a double taxation avoidance agreement. It's a double taxation avoidance agreement. So India is having the DTAA agreement for more than 90 countries so as to avoid the double taxation, right? And further, there are the methods for it, like the exemption method, like income exempt in residence country, or tax credit method, the foreign tax allowed as credit, or lower rate method, like lower treaty rate would be applicable. So for the different countries, the different methods are there. Like exemption method says that the income tax in source country is fully exempted in residence country. The tax credit method says like the tax paid abroad is allowed as credit, right? And the lower rate method says that with the treaty country will be having a lower tax rate. Okay. Then the very important one, it's about the heads of the income. There are the different head of income. Like the first, it's related to the salary. The first one, it's related to salary. Like you are earning salary, DA, HRA, pension, etc. And further, the standard deduction allows at rupees 75,000 for this. The standard deduction which is allowed is 75,000 for this. Okay. And further, there were exemptions under section basically 10 HRA, LTA, gratuity, etc. That's basically related to it. And if the second head, it's related to house property, the income from house property, like the rental income that you're having from your owned property. Okay, so 30% standard deduction. And further, there was deduction like for home loan interest for up to 2 lakh rupees under section 24B. Under 24B, up to 2 lakh rupees if it is self-occupied. If it is self-occupied, right? And further, this basic deduction is allowed for self-occupied and also for, let's say, if it is rent out, then the 2 lakh limit is not applicable. Then it is unlimited. There is no upper ceiling in that scenario. For the housing loan interest, the deduction we are talking about, right? Further, the third head, it's about profit and gains from business or profession. So like business profit or the professional income is there, that will be covered into it. The net business profit, the commissions, those will be covered into it. Then it's about the capital gains. Very important. Like you sold the shares and you purchased them for rupees 1,000. You kept them with you for let's say 7 months, and you sold them for rupees 1,500. So you are having rupees 500 as a capital gain, right? And there is exemption related to the index cost, etc., or on reinvestment purposes. We'll be learning ahead, right? So that's basically about the capital gain. That's a fourth head of income, and it could be related to other sources like interest income, dividends, gifts, etc. That will be covered into it. So we have the heads of income, like we are having the salary. The second one, it's income from the house property, that is rental income, profit gains from business or profession, capital gain, or the other sources. Right? Clear with it so far? Now, after that, it's about the computation of house property income. It's about the computation of the house property income. Let's have a look at it. So first of all, it's like we are going to cover the step-by-step computation of annual value of house property. So first one, it's about the gross annual value, higher of actual rent or expected rent. That's a gross annual value, higher of actual rent or expected rent. That will be covered. If any municipal taxes, those are to be reduced, those are to be subtracted. And then we'll be having the net annual value, that is NAV. We'll be having the net annual value. And whatsoever the standard deduction that is allowed, that is 30% of the NAV it is allowed. So that is also to be deducted. And let's say if any interest that we are paying for like self-occupied, it is 2 lakh rupees maximally allowed. The deduction is allowed maximum for 2 lakh rupees. So that will be deducted accordingly, right? So that basically is to be deducted. And then we'll be having the income from house property. That's basically the final amount that we'll be having. So the first thing it's about that if you are having a house with you, you'll be looking at the gross annual value, like higher of the actual rent or the expected rent. Further, like if you don't decide what rent was available, let's say you just showcased that it is lent out for rupees 6,000. It is not the case. Let's say the municipal corporation says the fair rent is 12,000 rupees in this area, right? So the 6,000 won't be admissible for that scenario. So 12,000 will be admissible. So let's assume that it's 12,000, right, into 12. So it is 1,44,000 rupees, right? Now let's say you paid the municipal taxes of 5,000 rupees. Those will be subtracted, and you are having the net annual value of 1,39,000, right? And for the standard deduction of 30% will be allowed. So you'll be subtracting 30% of 1,39,000. So it will be 97,300 after subtraction, right? And let's say you paid an interest of 50,000 on the housing loan. So it will be like 47,300. So this will be the income from the house, which can be like set off against the salary up to rupees 2 lakh. Getting it? So set off of house property loss against other heads, it's like maximum up to rupees 2 lakh per year. Further, it's related to the self-occupied property. For self-occupied property, the GAV is taken as nil. No rental income is assumed if it is self-occupied. Only for home loan interest is deductible up to rupees 2 lakh in that scenario. Okay, but there is condition that loan must be taken after April 1, 1999, and the construction is to be completed within 5 years from the end of the financial year in which the loan is taken. So this condition is to be satisfied if you want to take the benefit of Section 24B deduction of rupees 2 lakh rupees like interest, home loan interest for self-occupied property. Clear? The notional rent income is not considered. Then after that, it's about the presumptive taxation scheme. Like presumptive taxation simplifies the tax compliance by estimating the income at a fixed percentage without maintaining the detailed books. So that's a PTS, presumptive taxation scheme, right? So resident individuals, HUF, the partnership firms which are not LLP, those will be eligible into it. And let's say if your turnover, if you're having the digital receipts up to 3 crore rupees, right? Or let's say you are receiving the cash up to 2 crore rupees, that will be eligible. For digital receipts, it's 6% minimum. And for cash, it is 8% of the turnover that is to be considered. And presumptive income is that particular case. That's 8% or 6% based upon it. Okay. Further, it's basically for 44 ADA. For business, it was like 44 AD. And for professionals, it is 44 ADA. And here, if your gross receipts are basically limit is 75 lakh rupees, and that's applicable for the doctors, lawyers, CAs, engineers, architects, etc. So gross receipt limit is 75 lakh rupees, and presumptive income is basically considered 50% of the gross receipt. 50% of gross receipt is considered. And for transport purposes, for the transport business, like for the owner of maximum 10 goods carriage, those are eligible for the PTS. And for the The fixed monthly amount is basically is considered to be the monthly income, and presumptive income is considered to be 7,500 rupees per vehicle per month for the transport owners, for transport business we are saying. Then it's about the TDS. It's about the TDS, that is tax deducted at source. Tax deducted at source. So the first one, it's about the salary. Like for salary, the section which is applicable is section 192, and further the income will be taxable as per the taxable slab. That's about the salary. The second thing, it's about the bank FD interest, or bank FD, or any other interest that you're earning on RD, etc. That will be covered under section 194A. 194A. And the threshold is like if you're earning interest more than 40,000, then it is basically TDS will be deducted. And for senior citizen, this limit is 50,000 rupees, right? And what TDS would be applicable? 10% TDS would be applicable. And further, for rental of the plant and machinery, for rental of the plant and machinery, it is covered under 194I. And if you're earning the rent of 2.4 lakh rupees, greater than 2.4 lakh rupees, then 2% of the tax rate would be applicable. It's for the plant equipment machinery. It's for the plant equipment machinery. And if you have rented out the land building furniture, right, that is also covered under 194I. And for that particular case also, the threshold is 2.4 lakh rupees. But that's basically like greater, that will be 10% of the TDS would be applicable there. And for the professional and the technical fees, that is covered under 194J. And like if you have like received 30,000 in once, or total aggregate 30,000 rupees in an year, then the professional fees would be 10%, and the technical fees, the TDS would be 2%. And for commission and brokerage, that is covered under 194H. If the commission is greater than 15,000, then it will be 5% TDS. For dividends, it is under 194A. If the dividends received greater than 5,000, then 10% TDS is to be deducted. If the winning or lotteries are there, if there is any winning, lottery, crossword quiz, whatsoever you have, like one, let's say Punjab lottery business, you have learned, basically earned more than 10,000, the 30% TDS will be deducted. And further, if it is rent by individual or HF, rent by individual or HF, then if you are earning for more than 50,000 of the rent per month, then basically it is 2%. Previously it was 5%, but now it is reduced to 2%. And the important rule is, like for all the categories of this TDS deduction, you do require the PAN. PAN is required, right? So if the PAN is basically not available, then the TDS of 20% would be like deducted. The 20% or the higher one, whichever is there. Let's say for one category, 30% TDS is there for lottery winnings. Then that 30% would be applicable, even if you basically don't disclose the PAN, right? And if you disclose the PAN, then the lower one would be applicable, like whatsoever it is. Not the lower one, basically, then the particular slab would be applicable as per the head. Okay. Then it's about the income tax slabs. It's about the income tax slabs. And there is a new tax regime which is now available. There is a new tax regime. There's a default regime now from the financial 2023-2024. And there is a standard deduction which is allowed for 75,000 rupees for salaried employees. For salaried employees, the standard deduction of 75,000 rupees is available. And the tax slabs are like up to rupees 3 lakh, 3 lakh to 7 lakh, 7 lakh to 10 lakh, 10 lakh to 12 lakh, 12 lakh to 15 lakh, and above 15 lakh. So there are total 6 slabs. Total 6 slabs are there, right? For up to 3 lakh rupees, it is nil. To 3 lakh, it is nil. 3 lakh to 7 lakh, 5%. 7 lakh to 10 lakh, 10%. 10 lakh to 12 lakh, 15%. 12 lakh to 15 lakh, 20%. And above 15 lakh, 30% it would be applicable. And there's a key update related to the budget 2025. There was a key update. Like zero tax under the new regime. Like if you're having the net taxable income up to rupees 12 lakh. If you're having the net taxable income of up to rupees 12 lakh, then the zero tax liability will be upon you. Zero tax will be payable. And basically the effective limit for the salaried person would be what? Because they're getting the 75,000 as a standard deduction also. So if you're having the total salary of up to 12 lakh 75,000, like the total net taxable income is up to 12 lakh 75,000, it is still zero tax liability will be upon you, right? So we are to understand the things between, first of all, we are to consider one thing about rebate and exemption. Now, rebate is actually what? The tax calculated first and then then basically the rebate is reduced. So for rebate, the tax calculation is done first. The tax calculation is done first. And then basically the exemption is there. So rebate is basically not exemption. Rebate is not exemption, right? So tax is calculated first, then the value is reduced, right? And further, if we look at the old tax regime, like for individuals below 60 years, the old tax regime was something like this, like up to 2,50,000 nil, then 2,50,000 to 5 lakh 5%, 5 lakh to 10 lakh 20%, then above 10 lakh 30% there for the individuals below 60 years. And for resident senior citizens, it started from 3 lakh, like the basic was 3 lakh. Then for the 3 lakh to 5 lakh, 5 lakh to 10 lakh, and above 10 lakh. After that, same. The difference is here. And for super senior citizens who are aged 80 years and above, it's starting from 5 lakh. Like the 5% slab is not there. In case of super senior citizens, like up to 5 lakh to 10 lakh, and above 10 lakh. That was a slab for super senior citizens. And if we look at the differences between the old regimes and the new regime surcharges, let's have a look at it. Like if you're having the total income up to rupees 50 lakh, then the surcharge is basically nil. Surcharge is nil. And if you're having the income 50 lakh to 1 crore, it is 10% in both the cases. And for the 1 crore to 2 crore, 15% in both the cases. If 2 crore to 5 crore, still 25% in both the cases. And only above 5 crore, it is basically 37% as per the old tax regime, and it is capped at 25%. 25%, right? And further, the health and education cess is 4%, stable for all. This applies for both old regime as well as the new regime. And it is applied on like income tax plus the surcharge. Like whatsoever the income tax liability is there, that will be calculated, plus whatsoever the surcharge is applicable, that will be calculated, and over and above the health and education cess will be calculated. Getting it? Clear with it so far? Do confirm. Very important sections, right? So right today we'll be covering this much only, and after that the next topic will be covering the next video. So I hope that you must have learned the concepts and definitely must have liked the video. So do rate this video out of 10. Make sure to like this video and share this video. and the complete study plan is now available. Like the new study plan is available. You can be deciding at your own pace. You have to select the papers, you have to select everything, you have to put the data into it, right? And further, you can be generating a study plan right away from it. So for that particular purpose, you have to visit the website. What website? You have to visit the link I have already shared, that is learningsessions.in. The link is learningsessions.in slash study hyphen plan, right? So you need to just visit this link and you'll be able to find the details over there. You can be generating this study plan for you so that you can schedule right away from today onwards that what particular subject you need to focus upon and what topics you are to like focus upon so that you can clear the exams in time. So that will be all. Thank you so much and see you again in the next video.